Hey everyone, and welcome back. We're diving deep into something that I think a lot of people get confused by,
Yeah.
capital gains taxes.
Yeah.
And whether you're getting ready for tax season or maybe planning some big investments or just kind of curious about the whole world of finance, this one's for you.
Absolutely.
So we don't just want to define capital gains taxes. We actually want to give you some practical knowledge you can use to make smarter decisions.
That's the goal.
Yeah. So we're going to be talking about how are different assets taxed?
Right.
Like how are stocks taxed versus real estate or even
Crypto?
crypto. Like how did that all work? And then we're going to unlock this whole idea of long-term gains.
The magic.
Yeah, and why patience can really pay off when it comes to your money.
Yeah.
And then even some strategies that might help you lower your tax burden.
Who doesn't want that?
I know, right?
Yeah.
So I'm excited to break it all down. I think it's amazing how many people miss out on saving money just because they don't quite understand capital gains.
100%.
So let's just start with the basics. When we talk about capital gains, what are we even talking about?
Yeah, I think that's a great place to start because sometimes people get really confused by the financial jargon, right?
For sure.
So at its core, capital gains is simply the profit that you make
Right.
when you sell an asset for more than you originally paid for it.
Got it.
So let's think about this. You buy a vintage comic book
Yeah.
to $20 and you hold on to it for a couple years and you sell it to a collector for $200.
Wow.
That $180 profit, that is your capital gain.
Okay. So it's not just stocks and bonds. It's anything that I
It's anything.
sell for a profit. I could potentially be
Got it.
paying taxes on that.
Yeah, a piece of real estate, a rare baseball card,
Okay.
cryptocurrency, you name it.
Interesting. Okay. So we know the government wants a cut, but how much are we talking about here? Is it the same as my income tax?
It's a great question, and that's where it gets interesting
Uh-huh.
because there's a difference between short-term and long-term capital gains. Right. And really understanding this can be a game changer. So short-term gains apply to assets that you've held for 1 year or less
Okay.
before selling them.
Okay.
And those are taxed at your ordinary income tax rate.
Ouch. So if I'm just buying and selling stocks every few months, I'm
You could be.
potentially losing a lot to taxes.
That's right. That's why patience comes into play.
Right.
Because long-term capital gains are taxed at a much lower rate,
Okay.
sometimes even zero.
Right.
So this incentivizes investors to have a longer-term outlook,
Yeah.
which generally is going to lead to better outcomes.
So time really is money in this case.
It really is.
Can you break down those long-term capital gains rates for us? Just so we have a sense.
Absolutely. So for 2023, if you're single and your taxable income is below $44,625, or married filing jointly, and it's under $89,250, you pay no tax on your long-term gains.
Wow, that's incredible. 0%.
Zero.
Okay, and what if you earn a little bit more than that?
So if you are single and your income falls between $44,626 and $492,300, or married filing jointly between $89,251 and $553,850, you're going to pay a 15% capital gains rate,
Okay.
which is still significantly lower
That's still really...
than most income tax rates. And then anybody making above that, it's 20%.
Okay, so even if you are in a higher bracket, holding on to those investments for over a year can lead to some serious savings.
You got it.
That's huge.
And it gets more nuanced.
Okay.
And you consider that different types of assets have their own tax quirks.
Okay.
So stocks, bonds, mutual funds, they're generally going to follow those standards we just talked about.
Yeah.
But things like real estate, cryptocurrency, even comic books, they have their own set of rules.
My head is spinning a little bit here.
Yeah.
Can we walk through some of those different asset types?
Yeah.
Kind of what makes them special? Because I feel like
Yeah.
people are investing in everything from rental properties to,
To sneakers?
rare sneakers these days.
Yeah.
So let's start with real estate.
Okay. Good one, because there's a massive perk there that I think a lot of homeowners don't even realize.
Okay.
So if you've lived in your primary residence for at least 2 of the past 5 years,
Okay.
you can exclude up to $250,000 of profit from capital gains
Wow.
when you sell. And that jumps to $500,000 for married couples filing jointly.
Wait, so hold on. I could sell my house, make a good amount of profit, and not pay any taxes.
Yeah. That's the power of the primary residence exemption.
That sounds too good to be true.
It's pretty incredible. And again, it applies to your primary residence,
Okay.
not to rental properties.
Right. So no flipping houses and getting out of that.
Exactly.
What about cryptocurrency? How's that taxed?
So the IRS views cryptocurrency as property,
Okay.
and so any profits from selling or exchanging it are subject to capital gains taxes, just like stocks or real estate.
So if I bought Bitcoin like way back when, and I held it till now,
You'd be in a much better position.
I'd be paying way less taxes.
Way less than if you bought and sold within a year.
Okay, okay.
Interesting. Now for collectibles.
Uh-oh.
So this is where it gets a little tricky, like your comic books, Pokemon cards.
My Pokemon cards, are those going to be taxed heavily?
So the IRS doesn't necessarily see eye to eye with collectors on this one.
Okay.
And collectibles are generally taxed at a higher rate, a flat 28%,
Ouch.
regardless of how long you've held them.
So much for my Pokemon card fortune.
Ay.
Okay, but at least we have long-term gains on our side for other things.
Right?
And you mentioned earlier that even capital losses can actually work in our favor, right?
100%.
Tell me more about that.
So remember, we defined capital losses as selling an asset for less than what you paid for it.
Right, yeah.
The IRS allows you to use those losses to offset any capital gains you might have.
Okay.
So essentially what you're doing is reducing your overall taxable income.
So it's like a consolation prize for making a bad investment.
Kind of. Let's
Yeah.
say, for example, that you made a $10,000 profit from selling stocks. But then you also lost $4,000 on a tech investment that didn't quite work out.
Yeah.
Instead of paying taxes on that full $10,000, you can actually use that $4,000 loss to offset your gains.
Okay.
So you'd only pay taxes on $6,000.
Interesting. So it's like fitting the puzzle pieces together to try to get
You got it.
the best outcome.
It's strategic.
I like it. And there's a strategy, right?
Tax loss harvesting.
Yes, tax loss harvesting. So I could actually choose to sell something at a loss just for that benefit.
A lot of people do it.
Interesting. Okay, that seems counterintuitive.
It does. But it's a way to strategically lock in those losses
Okay.
and reduce your tax burden.
So it's not just about maximizing your gains. It's about optimizing those losses.
Right.
Wait, are there any rules or limitations?
Okay.
Because there always seems to be a catch, right?
There is one.
Okay.
The wash sale rule.
Okay.
And this prevents you from buying back the same or like substantially identical security within 30 days of selling it at a loss.
Okay, so no funny business. I can't just buy and sell the same stock over and over.
Exactly. The IRS is on to us.
But even with that rule, tax loss harvesting seems like a pretty powerful tool.
Yeah, for sure. And while we're on the topic of tax rules, there's one more that you should be aware of, especially if you're a high earner.
Okay.
And that is the net investment income tax, or NIIT for short.
Another tax. That's why I like having you here to break it all down. What's the NIT?
So it's an additional 3.8% tax on your investment income,
Okay.
including things like capital gains, dividends, interest for those who have higher incomes.
Okay.
So it's just something to keep in mind if your modified adjusted gross income, or MEGI,
Right.
is above a certain threshold.
And what are those thresholds?
So for 2023, the NIIT kicks in if your MEGI exceeds $200,000 for single filers
Okay.
or $250,000 for those who are married filing jointly.
Okay, so this is really for people who are
Yeah.
doing quite well.
Yeah, but even if you're not there yet, it's good to know about.
Absolutely.
For future planning.
You never know what the future holds.
Uh-huh.
Okay, well, this whole conversation has been eye-opening.
Good.
I feel like I'm starting to see capital gains not as just a burden,
Right.
but like a puzzle to be solved.
It is. It's a game.
It's a game, yeah.
And now that we've kind of set the stage,
Right.
let's move into some strategies to minimize those taxes and keep more of that hard-earned money in your pocket.
Yes. Let's talk strategy.
All right, so let's get into some strategies. And, remember earlier when we were talking about those favorable long-term capital gains rates?
Yeah.
Well, that's strategy number one. Time is your ally.
Right.
The longer you can hold on to an investment,
Yeah.
the lower your tax burden is going to be.
Patience really does pay off.
It does.
But let's be honest, not all investments
Right.
are meant to be held forever. Sometimes you have to sell for various reasons.
Yeah.
So what are some other things that we can do
Sure.
to kind of minimize those tax hits when we do sell?
Well, one strategy that requires a little bit of, foresight and planning is timing your asset sales strategically.
Okay, like how does that work?
Yeah.
How can timing really impact my taxes?
Well, it all comes down to your income bracket. So if you anticipate a year where your income might be lower than usual,
Okay.
maybe due to a career change, or you're taking a sabbatical, or maybe just reducing your work hours,
Right.
it could actually be beneficial to sell assets
Okay.
during that lower income year.
So you're kind of taking advantage of being in a lower tax bracket
Exactly.
and
Belle.
paying a lower percentage.
You got it.
So it's all about being proactive and really thinking ahead.
It is like a chess game almost.
Yeah. Okay. I like that. Now, you mentioned one more strategy, I think, before we took a break that sounds really interesting for real estate investors.
Yes.
This whole 1031 exchange. Can you walk us through that a little bit?
Of course. So the 1031 exchange is a fantastic tool for real estate investors who are looking to defer capital gains taxes.
Yeah.
So essentially what this allows you to do is sell a property and then reinvest the proceeds into a similar property
Okay.
without immediately triggering that capital gains tax liability.
So you're kind of hitting the pause button.
You're exchanging one property for another, hence the name.
Okay.
Now, it's important to note
Yeah.
that there are specific rules and timelines involved in this.
Right.
So it's always a good idea to talk to a tax professional to make sure you're doing everything correctly.
Right. I feel like real estate transactions always get a little complicated.
A little bit. But it can be a great tool.
Definitely. Okay, so we've talked a lot about capital gains kind of in this context of taxable investments, but what about retirement accounts?
Yes.
How are capital gains treated within those?
That's a great question. So retirement accounts are designed to encourage long-term saving, and they come with their own set of tax advantages,
Right.
which makes them really smart for managing capital gains.
So it's not like a one-size-fits-all. There are different...
Different rules for different types of accounts.
Can you break it down for us?
Absolutely. So there's two main types of retirement accounts to consider. Tax-deferred accounts, like traditional 401ks and IRAs,
Okay.
and Roth accounts, like a Roth IRA or a Roth 401k.
Hmm.
So with tax-deferred accounts, you're contributing pre-tax dollars,
Okay.
meaning you get a tax deduction up front.
Right.
Your investments grow tax-deferred,
Yeah.
and then you only pay taxes when you withdraw the funds in retirement.
So it's like delaying those taxes, like we were talking about with
That's
the,
kind of,
with
yeah.
the real estate thing, but it's for retirement savings.
You got it. And that's one of the biggest perks of those tax-deferred accounts.
Right, so you're letting those gains just compound
Exactly.
tax-free for years.
Now, Roth accounts work a little bit differently.
Okay.
So you're contributing after tax dollars, so
Yeah.
you don't get that upfront tax deduction.
Right.
However, qualified withdrawals
Okay.
in retirement are completely tax-free,
Oh, wow.
including any capital gains you might have accumulated.
So all those years I'm like holding these investments,
Yeah.
watching them grow, all that profit, I don't have to pay taxes on any of it.
Not a penny.
That's amazing.
It's the magic of Roth accounts.
Okay, I am rethinking my retirement strategy after this conversation.
Good. It's a great option.
So it sounds like retirement accounts are a pretty powerful tool
They can be.
for managing those taxes
Ah.
while also building up a nice nest egg.
Exactly.
Now, what happens if my losses actually exceed my gains in a given year?
Yeah,
Is there anything I can do?
that's a great question.
Like, can I use those to offset other income to maybe reduce my overall tax burden?
It leads us to one of the most valuable things about capital gains taxes, the ability to actually use those losses strategically. So you were asking about when our investments don't work out and we end up with those capital losses.
Right, right. Everybody has those. It happens.
And there's actually a silver lining when it comes to taxes.
Okay.
The IRS actually lets you use up to $3,000 of net capital losses to offset your ordinary income every year.
Wait, so even if I don't have any capital gains that year,
That's right.
but I have, let's just say, $5,000 in losses.
Yep.
I can still deduct $3,000 from my income.
You got it.
That's like a tax break for making some bad decisions.
Kind of. It's like a partial refund on those losing bets.
Okay.
And if your losses are more than $3,000,
Yeah.
you can actually carry those over
Okay.
to future tax years and offset gains or income down the road.
That's like a safety net.
Exactly.
Okay, this is amazing. I never realized that losses could be so valuable.
Yeah, it really adds a layer of,
Sophistication.
sophistication to your tax planning. And it highlights how important it is to be thinking about your finances holistically,
Yeah.
thinking about gains and losses.
Right. It's not just about winning. It's also about how to use those losses strategically.
Right.
Well, this has been a game changer. I feel like I've gone from dreading capital gains taxes
Right.
to actually understanding how I can kind of use this to my advantage.
That's the goal.
So what are some of the key takeaways our listeners should remember from today?
Well, first and foremost, remember that time is your friend when it comes to capital gains. Holding those investments for the long term can really reduce that tax burden.
Right.
Don't underestimate the power of those tax-advantaged accounts like the 401ks and IRAs.
Yes.
Those can really help you accumulate wealth more efficiently. And then finally, remember that capital losses, Those aren't just setbacks, they can be strategic opportunities.
Yeah.
So use those strategies like tax loss harvesting, offsetting your ordinary income with those losses to really minimize your tax liability.
Those are great points. Any final words of wisdom before we wrap up?
I would just say embrace the journey. Personal finance is a lifelong learning experience, so stay curious.
Yeah.
Keep educating yourself and don't be afraid to ask for help when you need it.
I love that. And to our listeners, we want to hear from you. What strategies are you going to explore now that you've got a deeper understanding of capital gains taxes? Share your thoughts, and let's keep this conversation going. Remember, knowledge is most powerful when it's shared. Until next time, happy investing and keep diving.